What is going on, guys? Mark Roberta here. In this video, I'm going to talk about options trading. Is it risky? Is it safe? Is it something you should incorporate in your strategy? That's what this video is going to be all about. Now, just for context, as we get into this video, understand that any investment does have a level of risk. Real estate, the price of that can go down. Stocks, the price of that can go down. Options, the price of that can go down. Every investment and even not investing, it all carries a certain amount of risk. If you don't invest, that's more of like an opportunity cost where you're missing out on great opportunities. So there's risk with all these different decisions. Now, some of them do carry more risk than others. You look at something like an AT&T, which isn't super volatile. You look at something like Tesla, which definitely has a lot more risk, but also a lot more reward. So sometimes you do enter higher risk areas for that potential of a greater payout. Now, let's go into options, because options, you have some strategies that are risky, and people think of options, they think of risk, they think stay away, I don't want to take this risk. And a lot of people don't understand options. You have other option strategies that are really not that risky at all and help you with your portfolio goals. So when a lot of people think about options, they just think about buying. They buy the call, they buy the put. If you buy a call, you're hoping the stock is going to go up. If you buy a put, you're hoping the stock will go down. And there is a certain time frame that these calls and puts expire in. And if you're out of the money, so let's say you have a strike price on a call of $100 a share, you're able to buy 100 shares of that company at $100 per share. If that company is at $90 the time the contract expires, that call is worthless. All the money you put in turns into zero. So that is the risk when it comes to calls and puts when you buy them. And you can do something that expires in a week if you want to be super risky, but then not spend too much on that contract. You do something that expires in a month, 3 months, 6 months, a year, even 2 years, which the longer you have until expiration, you have less risk, but then you also pay up more to buy that call or put. And this is a strategy where you could turn $2,000 into $100,000, and you could turn $100,000 into $2,000. It's all based on how the stocks move. So if you really want to buy calls and puts, I recommend doing that with like 0.5% or 1% of your portfolio, because that is a lot of risk to take on. Some people, they just buy, they use their whole portfolio worth to buy calls and puts. And this is an extremely risky strategy where if it goes well, you could probably retire based on how much you made. But if it doesn't go well, you are literally back to square one. So that's just the risks with those investing assets. But selling options is something that people don't think about that one as much. And it is a great opportunity to build up income, to sell your stocks the price you want to sell them, to buy stocks at the price you want to buy them. And people think that selling options is risky because they only think of one half of this equation. If you buy uncovered, if you sell uncovered calls and uncovered puts, that is an extremely risky game. If you ever hear people like losing their shirt through options trading, if you ever hear about people like their portfolios falling apart, it's usually because they sold uncovered calls, uncovered puts, or they got greedy and bought way more calls or puts for a certain company or ETF than they should have. So a lot of the stories you hear about options that don't work out is usually fueled by a lot of greed and not having the proper outlook towards risk. So we'll talk about how these selling the options work. Covered calls, cash secured puts, those are safer. You'll understand in a few minutes. So pretty much what a covered call says is you get paid, and if a stock price hits a certain level, you have to sell 100 shares of that stock to someone else. That's all a covered call is. So if there's a stock $100 right now, and you say, like, I agree to sell this to you at $110 a share, and you get, let's say, $100 in payment right away, then you get the guaranteed money, the $100. If the stock doesn't hit the 110 level, then you get to keep the payment and you get to keep the shares. If the stock goes to 110 and above, you have to sell at 110. So if the stock goes up to 130, you still have to sell at 110. So with a covered call, it's not like you can lose money, because the only way you lose money is if a net loss is if the stock goes down in value. So if you buy and hold a stock, it's the same exact scenario, except you have a premium acting as a cushion. So that's the only way you end up in a net loss. The other part is that, well, if it does go up to $130, you miss out on the potential of making that extra $20 a share. Since we're talking about 100 shares that you need for a covered call, in this scenario, you miss out on $2,000 of extra gain. It's not a loss. It's just you missed out on an extra gain because the shares still went up from $100 to $110. You get that $10 per share appreciation, and then you got the premium as well. So there are different stocks you could pick where maybe you want a growth stock that gives higher premiums. Maybe you want a less risky play like a dividend stock that doesn't give high premiums, but the stock price it's not known to move as much. And if you do sell a stock using covered calls, you could always get back in with a cash secured put, which is a covered call in reverse. So pretty much you say, I want to buy the stock at $100 if it goes up to 110. And you get paid for saying, I want to buy 100 shares at this price. Because if the stock goes down to $90, someone will be very happy to sell you that stock for $100 a share. But at the end, if this cash secured put gets exercised, you then end up with 100 shares at $100 plus the premium associated with you making that agreement with someone else. So that's pretty much how selling the options work. It's really not that risky if you already have the money in the form of a cash secured put. So you would put $10,000 in this cash secured put to buy the 100 shares at $100 each. In the case of a covered call, you already have the 100 shares. And it's the people who do uncovered calls and uncovered puts who, I don't know how these people sleep at night, because you don't have the shares. And let's do a covered call, for instance, $100 stock. You say uncovered call 110. I understand why people do it, because then you don't have to accumulate the 100 shares, or you don't have to accumulate enough money for a cash secured put. But now let's say that the stock in an uncovered call goes from $100 to $130 per share. Now it's not like the previous example where, oh, you still made $10 a share. You just missed out on like $20 per share upside. So you still ended up in the green. In an uncovered scenario, you first have to cover it by buying those 100 shares at market value. So in this case, you would have to buy, instead of having the 100 shares that you already had in your account, you already got them at like $100 a share. Now you have to buy them at $130 a share and then instantly sell them for $110 a share. So there is no like 100 to 110 where you gain there is no appreciation, and it's only you bought at the top and you sold at this low level. And that is why I don't even want that feature on my account. I don't have it. I'm not in a rush at all to do these uncovered calls and puts. That is where the risk is. If you feel like if you don't have enough of a portfolio at this stage where you can't amass the 100 shares, or you can't do a cash secured put, you can look for more affordable stocks that are under $50 or under $20, depending on what your portfolio looks like, that aren't risky. So we're not talking about Kodak. Stay away from that one. But don't be in a rush to do the uncovered calls and puts. That is an extremely risky game, as is just stuffing your account with calls and puts that you bought, because those could multiply significantly, but they get hit zero just as much. So options, in summary, is a really great investing capability where you can compound your returns over time through selling covered calls and cash secured puts. And to me, it definitely is far better in terms of money you make and options you have, choices you have. I don't want to get into that pun, but it gives you more choices into what you invest in while being able to produce income. So Apple, for instance, or any big tech growth company, like Apple pays a dividend, but come on, guys, no one buys Apple for the dividend. But the options, selling covered calls, and you can set these really far out of the money if you don't want to sell your shares. And there are other ways I talked on a previous video where you decrease the chance of having to sell the 100 shares if you don't feel like doing that. It's going to crush the dividend return. And now any company that you can trade options for can kind of produce a dividend. So that is pretty much like the way I like to do options. I like to buy calls and puts from time to time as well. I'm not putting a ton of money into it because you could, lose the money you put into buying calls and puts. But buying puts is in some ways less risky than actually shorting stock, because while a put could definitely go down to zero, in the case of shorting a stock, you have the potential for unlimited loss. You can also hedge. You can buy a call. If you short 100 shares of a stock, you buy a call, then you do cap how much you could lose in the short position. Similarly to how if you have 100 shares, you buy a put to cap your losses, because if you have 100 shares, $100 each, you buy a put with a $90 strike price, and then the shares go down to $70 because of some economic stuff, or maybe the company, something happened there, you could still sell at $90 even though the company is currently trading in the marketplace for $70 a share. So there's a lot of different ways you can utilize options. I think for anyone getting started, doing a covered call or a cash secured put that expires in like a day, very far out of the money, you're going to make very little from that deal. But to me, I think that is a great way to get started. I feel like once people dip their toe in, they see that it's not as risky if you do it with the right mentality. It can be extremely risky, as investing in general can be extremely risky if you approach it from the wrong mentality, where you're just chasing dollars and you want the dollars quick and now, and you want to be a millionaire now. Like when people think like that, they sometimes make really incredible risks with their portfolio, and then they fall into risk of starting all over. So I know this is a pretty long video about options. I do hope you guys enjoyed it. Let me know in the comments if you have any questions or you want me to cover something in a future video. But in any event, hope you guys enjoyed it. I'll see you guys next time.